Welcome back to Stock Sage Insights. I'm Sir Faraz, and today we're diving into an extraordinary topic. We will be talking about companies that have stood the test of time by paying dividends for over 100 years. In fact, one of the companies that we will talk about today has been paying dividends for over 200 years. Let's explore these titans of consistency and see which one emerges as the best pick for our portfolios. Dividends are a favorite among income-seeking investors, but their appeal goes far beyond just income. They're crucial for building generational wealth. Research shows that dividends have contributed a massive 40% to the total returns of the S&P 500 since 1930. The compounding effect of reinvested dividends can deliver phenomenal returns. Just imagine what this would be like for companies that have never missed a payment in over a century. So, who are these venerable companies? Here is the list, and, as you can see, it includes household names like Coca-Cola, with 104 years of dividends, ExxonMobil at 112 years, and Stanley Black & Decker, nearing 150 years. I'm sure you would have heard about most of these names, but York Water might be new. It's a small water utility company from Pennsylvania with a market cap of $500 million. York Water has been paying dividends for over 200 years. I think this might be the only listed company in the US that has made over 600 consecutive quarterly dividend payments. York Water currently offers a dividend yield of 2.32%. Now, it's one thing to pay dividends, but consistently growing them year after year is a whole different game. This is where well-established companies with solid business models shine. So let's examine these companies from the perspective of dividend growth. If we look into their history, it is revealed that all of these companies aren't just long-time payers. They're what is called dividend aristocrats. Dividend aristocrats are those S&P 500 companies who have an incredible track record of growing dividend payments for at least 25 consecutive years. Note that York Water is not an S&P 500 company, but we are being a little liberal with the definition here and focusing on the history of dividend growth, not the market cap. Interestingly, York Water, despite its long history, has the shortest streak of increasing dividends among our candidates, although 26 years of growing dividends is still an impressive feat. On the other end, we have Procter Gamble leading the pack with an incredible 68 years of growing dividends. Interestingly, we have 4 dividend kings in our list as well. Dividend king refers to those companies that have grown dividends for at least 50 consecutive years. It is an even more exclusive club than the dividend aristocrats, and only 51 companies have been able to meet this tough criteria. Stanley Black & Decker, Colgate-Palmolive, Coca-Cola, and Procter & Gamble are 4 companies that have all grown dividends for more than 50 consecutive years. To further narrow down our options, let's examine their revenue and earnings growth. Why should we do that? Because sustainable dividend growth can only be fueled by healthy revenue and earnings growth. Unfortunately, Stanley Black & Decker falls behind in this aspect, despite offering the highest yield of 3.4% among the 4. Its revenues and EPS have been declining, with analysts expecting this trend to continue in the future. Colgate-Palmolive and Coca-Cola have shown revenue growth, but their earnings came under pressure this year, although analysts expect them to post earnings growth in the future. However, standing tall above them all is P&G. It's the only company among our final 4 that's growing both its revenues and EPS. Let's delve a bit deeper into P&G. This company isn't just a business, it's a cornerstone of American commerce with an operational history spanning over 185 years. P&G has become a ubiquitous presence in households around the globe. From the United States to Pakistan, it's hard to find a grocery shopping list that doesn't include at least one P&G product. Their expertise in generating revenue is unparalleled. In the last 12 months alone, P&G has raked in $80 billion in revenue and $15 billion in net income, boasting an impressive profit margin of 18.3%. But they don't just hoard these profits. P&G has a tradition of sharing its success with shareholders through dividends, offering a respectable yield of 2.55%, while reinvesting the remainder to fuel further growth. PG's status as a blue-chip dividend stock can't be overstated. It represents not just stability, but also a legacy of growth and shareholder value. Now, let's talk about the company's valuation. PG's shares are currently trading at around 24 times forward earnings estimates. This is higher than the broader consumer staples sector's median of 18 times forward earnings. But remember, quality comes at a premium. In my view, PG's valuation is reasonable given its track record and market position. When considering investments, remember to look beyond just the reported numbers. Sometimes earnings can be skewed by one-off items, so a deeper dive is always beneficial. But we'll save that detailed financial analysis for another video. Thank you for joining me today on StockSage Insights. If you enjoyed this deep dive into dividend royalty, please like, subscribe, and consider supporting me on Patreon. Your support enables me to bring more high-quality investment insights to you. Stay tuned for our next video. Also, note that this video represents my opinion and it's not investment advice. See you next time.